2 months back, I had a conversation with my father, and he said to me, he's 78, and he said, "You're doing fine in life. Have you become an angel investor yet?" So the reason I tell you this, that everybody who has money or spare money either is an angel investor or wants to become an angel investor. Right? And which is good for the ecosystem. But what does it really mean to be an angel investor? And then what are the legalities behind it, right? Like a lot of us understand, oh, you invest money in this company, that's it. But what is the documentation required? What are the legalities? And that's what we're going to discover today with Karun. Okay, so I'm really going to start, Karun, by first question. What are the documents one should look at when you are investing?
Thanks very much for having me over today. I think from an angel investing perspective, there are a number of documents that we look at from a legal perspective. Obviously, if you're a founder, one of the first things that you want to make sure is that all your information, your confidential information, is actually protected. So you may have a non-disclosure agreement that you'll enter into with a potential investor to make sure that none of your proprietary knowledge or information is actually shared with anyone. Obviously, the next one will be a term sheet. There are two types of term sheets. One is a long form term sheet or a short form term sheet. What's the purpose of having a term sheet? It's goal setting. It's to make sure that people understand, the investors understand, and you understand what exactly it is that you're signing up for. And these could be conceptual points that you discuss in your term sheet. I'm a big fan of actually having a detailed long form term sheet from a founder's perspective. It puts they pay a lot more attention to the deal that they're trying to strike with investors. But if time is short, then obviously you need something which is already preset. It's like a cut and paste, I don't want to say, but because each deal is kind of unique. But you want it to be more or less set in the sort of format, in the terms that you want to sort of agree to. The benefits of doing a term sheet is that you have exclusivity, you have a time period within which people can actually kick the tires of the company, understand whether you want to do this deal or not want to do the deal. And then you don't necessarily need to go out to multiple other partners or other parties to see whether you want to invest or not.
I have a follow-up question, especially early stage investments, right? How much due diligence does one need to do?
That's a great question. It's a question that we get asked all the time. Due diligence is like if you're buying a car. How do you understand whether a car is a good car, suits your purposes, has a great engine, or doesn't have a great engine, has the right sort of papers, etc.? So similar to any sort of investment that you make, you need to look under the hood. You have to understand that you're taking risk. You're taking on risk as an investor. Yeah. But for you as a founder as well, you need to be able to sort of tell people that, look, I've given you everything that I know about the company. And the purpose of due diligence is basically it's risk allocation. When an investor comes in, do they actually appreciate and do they actually know what they're actually investing into? What are the sort of pitfalls that the company has had to go through? Have they resolved those pitfalls? Have they not resolved it? How can we cure those pitfalls? So due diligence is it's an ongoing exercise. There's legal due diligence, there's financial due diligence, there's tax diligence, there's privacy. Data privacy is such a big factor today. That's also important for you to sort of delve deeper into. Tax diligence, obviously, because you can't escape taxes. Right. So there's a number of areas that you need to do diligence on. For early stage startups, very early, obviously a lot of the corporate governance issues may not already be there. Right. So I think for angel investors, it's important to diligence the business of the company. What is it that the business is actually trying to achieve? What is it that they actually have in place? The rest of it obviously can come later. Yeah. As the company grows, it has more people that they can invest in, financial controllers, et cetera, et cetera.
What about leadership due diligence? Do people really do any due diligence on leadership of the founder or of the founding team? Like, to what extent do investors do that or should do that?
Absolutely. I think who are you really investing in? You're investing in the vision of a founder. So the founder's antecedents, understanding who they are, what their reputation in the market is also super important. We're finding, even in the legal profession, we're finding that a lot of our clients are coming to us and asking us, we need to do integrity diligence, which is basically understanding who the founders are. Can you help us with that? So I think from a founder's perspective, you have to adhere to certain norms, make sure that your reputation in the market is great. How you treat early stage investors, if you've done previous businesses, is also very important. And obviously your peers, your network, your sort of where you worked before, all your sort of experience, all of that will also come to light. So it's very, very important. I think, with early stage investing, it's the person behind the company that you're investing in. So it's very important.
I'm glad you said that, because I was just reading some articles and there was a thing about that how investors don't spend, they didn't say they don't spend any, but they don't spend enough time maybe, right? There's a lot of focus more on the Excel spreadsheets, the business model, all of that. But that part is probably now maybe it's time where focus needs to shift when they've seen so many companies fail on that aspect, right? So I'm glad you said that. I want to move on to my next question. What are the typical rights package that, from both sides, minority investors or angels should look at, but also from founders' perspective?
Right. So the rights package is a mixed bag depending on who is coming in at what point. So if you're an angel investor, so from an angel investor's perspective, you typically don't really have too many rights. What you're doing is you're putting in a small check into your company, and you're not really looking into how the company is being run. All that you want is information rights. So the company needs to, or the founders need to actually get back in touch with you, maybe on a monthly basis or a quarterly basis, share some financial information with you, make sure that, any big major sort of decisions that they're making, including, for example, a future fundraising round, or if there's an acquisition opportunity, or if there's a significant hire, they need to let you know, but there's nothing much that you can really do about it. But if you're a late stage investor, obviously affirmative voting rights is super important. The information that you have with respect to the company, how quickly do they actually send you all the information, financial information, primarily information with respect to customers, anything major that's happening with the company, that's important. The other rights are obviously anti-dilution protections. If there's a further issuance of shares, how do you actually protect your interests? If there's an acquisition that happens, are you going to be dragged? Are you going to be tagged? These are rights that you'll negotiate into the agreement. But from an angel investor's perspective, you won't really get too many rights.
Where do people typically go to find out more, all the rules and all the things that you're talking about? Who do they go to, apart from coming to you?
I think nowadays you're finding that, there's a lot of information out available in the net. You've got in Singapore, you've got VIMA, which is a sort of platform where you get a lot of these standard form agreements. This is basically Singapore lawyers who have gotten together and have created certain forms so that you don't really need to spend too much time, with legal counsel advising you. That also saves costs for everyone. You want to get the deal done very quickly, you can do that. In the US, most sort of evolved markets, you've got your venture capital association forms that people use. That's very standard form. You've got detailed explanations also as to what your liquidation preference rights are, how anti-dilution works, what your preferential rights ought to be. All of these, all of these rights are all set out there in very, very basic language so that everybody can understand. So there's a lot of information out there, and people, I think, have made a conscious effort to make sure that both founders, angel investors, people who want to be part of this ecosystem have all of the information that they require.
What I also wanted to ask you is that when do people come to you?
Well, people come to me at all stages. They come when they're early stage. So I used to be a mentor at an early stage incubator in Singapore called JFDI many years ago. So I worked with a lot of the young companies who were set up under that incubator. They came to me every time they had like a little bit of a legal issue on a licensing problem. They'd be like, do I need to get a license in order to undertake this business in this market? Yes or no? And so I'd be able to help them with basic sort of legal advice. But of course, the details, the devil always lies in the details, right? So when you are entering into, say, your Series A agreements and then later agreements, obviously that's when people want to make sure that their rights are protected. For founders, for example, their ESOPs people come and ask us questions as to how we need to structure these ESOPs
Right.
when they are an acquisition target, when somebody is actually contemplating acquiring one of these companies. Then the founders want to make sure that their rights are protected, because one of the things is that
Yeah.
your obligations don't end upon you completing the deal
Right.
and taking the money. There are still indemnity obligations which have a certain tail period which you need to protect for. So how does a lawyer who understands what investors or acquisition targets are looking for, how does a lawyer sort of address that? That's when you need someone who can help manage the deal. So
Karun, I would assume that probably the complexity is much more when there's cross-border transactions involved, right? And I know we probably don't have so much time, but I would love to hear your thoughts on that. What
no,
does it take?
absolutely.
Yeah.
Cross-border, if you're used to investing in a certain market, you expect that the legalities also should be the same in that particular market. That's not always the case. For example, Singapore is one of the easier jurisdictions for you to make investments in. You have your exit rights, which are more, well set out. You know that if there's something were to go wrong, your redressal mechanisms are more, the rule of law really applies, so you know exactly what the outcome will be. In certain other jurisdictions, it's not so clear cut. So you need to understand what those risks are when you invest, which is, again, goes back to my point on due diligence. Something that may be absolutely legit in a particular jurisdiction may not be legit in another jurisdiction. Data privacy, each jurisdiction has its own nuances, its own, evolving area of law.
Right.
So as a result, you need to make sure that you've got the right experts for that particular jurisdiction who will be able to help. So that's one of the sort of pitfalls. The other is movement of money, investing into a jurisdiction which has got capital controls, such as India, for example, has got various rules, regulations that you need to comply with. So debt, for example, as an investor putting debt into an Indian company, it may or may not fit in with what the external commercial borrowing guidelines are, which is, India's Reserve Bank of India, India's sort of central bank, sets out where you can actually put debt. So all of these factors are issues that you need to consider. Make sure you've got the right advice when you walk into any particular jurisdiction, because it's a complex world out there.
I can only imagine. So last question before we ask the audience for questions. What are the exit scenarios for founders as well as for investors, angel investors?
Well, the most popular one, obviously, is IPOs or SPACs, when SPACs were going crazy a couple of years ago. The other is strategic sales. Obviously, I gave an example of an acquisition target coming and looking to acquire you. Founders exit, investors exit, everybody is happy, everybody walks away, you've got great money. Obviously, the IPO, the founders still want to be there. They still want to run the company. An IPO is a significant exit for them. Listing on a stock exchange anywhere in the world is quite a significant event for founders and for the company as a whole. Any sort of acquisition that comes, even if you want to look to buy a minority stake, maybe it may trigger your tag along or drag along rights. So all of these things could get triggered. So these are your typical exit scenarios. These are the great exit scenarios. I don't want to talk about the downside exit scenarios because that's maybe for another time. But these are the sort of exits that you would be looking for in your agreements.
Okay. Great. Thank you so much, Karun. I don't understand the legalities, but I understood at least a bit of it today. Thank you.
I hope so.
Thank you.
But if there's any questions.
Yes. Any questions from the audience?
I was having a dinner chat with someone who runs an angel network in India, and we were talking about how usually at the Series A stage, a lot of the initial angel investors especially get wiped out, right? And there were sort of two arguments largely on the table, which is one is they have taken the risk to invest so early on, and so you're expecting an amazing multiple, right? That's one perspective. The other perspective is when a Series A investor comes on board, at that stage, you want advice on growing and scaling, and the value of that angel investor isn't as great, right? And so I just want to know what your perspective is between these two, and what have you seen is better for startups as a founder, I'm asking.
Well, it's different strokes for different folks, right? So if you think that the angel investors have been with you for a number of years and they still continue to have faith in you, and they're looking for ultimate upside. So they don't need an exit scenario at your Series A level. They want an exit scenario at a much later stage. Then who are you to deprive them of that opportunity? They've helped you grow to a certain level. And then, if they want to see that upside until you go IPO or there's a significant strategic sale, then, that's something that they're entitled to. Your agreements will provide for that. Obviously, if you want to go and convince them otherwise, then that's up to you. I do know that it's easier for a brand new investor to deal with a simplified capital table. So that means you have less people that you need to interact with. So you need to factor that in your mind. Maybe at a later stage, you can take all your angel investors, you can create an SPV or a pool, and you say that, look, you guys sit in this pool, all the decisions will come from that pool by a consensus sort of like basis. And you will then, this pool entity, this SPV will then be the shareholder on my cap table. So everybody will get their pro rata rights sort of addressed in that manner. So there's various ways for you to structure this. It's obviously a lot of dialogue that you need to have with your angel investors as well. And we enable what the founders want, what the investors want, and we can always provide for it.
Question on the SAFE document. Do you feel that is protecting enough or giving enough rights to an angel investor? Because effectively, you don't exactly get any real, deadline, date, value, anything really out of it. It really is contingent on a significant future event happening. So what are the other alternatives that an angel investor might explore?
Great question. I think this is one of the issues with angel investing, is that your risk appetite has to be high, right? Because these are fledgling companies. They're not fully set out. There isn't publicly available information. You probably aren't even doing any diligence on these companies. You've met the founder. The founder comes and tells you, look, I've got this great company. I think it's going to go great guns. You will make a significant amount of investment. And you're like convinced. You have 1, 2, 3, 4, whatever, even 10 meetings, right? And then you say, right, you know what? I'm comfortable. When you put in money as an angel investor, you have to be able to walk away from that money also, right? That said, your SAFE agreement always has a maturity date. It says that, it's basically a debt which converts into equity at a future event, right? You will have an interest component in your SAFE agreement, and you will also have a maturity date in your SAFE agreement. The maturity date will be like, if you have not been able to undertake this future fundraising event by a certain period of time, then I should be entitled to get my money back, right? With interest. That's what the agreements provide for. Now, whether you as an investor can go and enforce on that, right, is a different question. Because by this point, the company's probably run out of funds. They don't really have any money. There's no personal liability that's been imposed on the founders themselves. So your risk appetite, like I said, needs to be super high for you to be able to take that hit.